Hi, this is Joe Rabil with Invest Like a Pro. I've got two stocks side by side here. On the left side, I've got the daily chart of Microsoft, and on the right, I've got the daily chart of Apple. Um, right during the same period, during this steep market decline, I'm using MACD just to show the strength. And let me just point this out. This would be where that's the zero line on the MACD. And let me just put it on Apple's as well. So we've got a really strong move down in both cases. Very powerful. What I'm going to try and show here is some subtle differences in why I would have, if I were looking to do a swing trade on this to the downside, I would have favored Microsoft, even though if you look at the way the MACD looks on the daily chart on the higher time frame, you might have been more inclined to want to do the Apple. This is why using the MACD to help with the timing can be very useful, but also understanding the price structure as an extra added element, I think is also important. So I'm just going to start with again, the first thing is violent move to the downside. Both the MACD and the signal line for both stocks cross down through zero. And then we get a rally, a 1, 2, 3 higher lows. So if you look at this bar here, and then you made 1, 2, 3 higher lows here. So in both cases, I would consider that a pinch play. We made a pretty strong move to the downside and then rallied up 2 to 3 bars with the MACD below its signal line. The pinch pattern's in my book, Invest Like a Pro. I've done some videos on it as well, so go back through and look at that. Also, please hit the subscribe button. Looking to get new subscribers on this thing so I can get more commentary, get more ideas for different types of videos to do. So let's go. What I want to do from this point is switch this to an hourly chart on both time frames. I'm going to actually scrunch this down a little bit so we get a little more history. So what we're doing, and we're looking at this period here in both situations, right? The stock had come down and had rallied back up. And so if you notice, MACD in both cases are actually doing the exact opposite on from the daily time frame. On the hourly time frame, we were actually crossing the zero line to the upside. And again, that's goes in line with what I've said in prior videos. When I'm using two time frames, the higher time frame determines the direction of the trend and the strength of the trend. And then the lower time frame should go counter to that before I get a signal. I should be getting an opposing trend to the main time frame or the tradable time frame. So I'm just going to clear this out for a second. And what I want to point out is during this rally, you moved up, made a pullback on Microsoft right now. You make a move here, you pull back, you make another higher highs, and then you move to this point. And so I can actually go in because I made a clear higher bottom. I can put a trend line in place. And if I go and look at Apple on the right side, I've got the same situation. I made a move up, a pullback, and then made a new move to the upside. So in both cases, I have a trend line in place. But look at the difference in the way the stocks acted with the trend line. Microsoft immediately broke the trend line on the pullback. Apple actually came down and held that and then moved higher. So if I'm looking at, this is a real important point here. You could go and look at the daily chart and you can do a trade off of a daily chart without looking at a different time frame. But if you go down to the smaller time frame, you can get a much better sense of how strong the rally is taking place more. It's almost like you're looking under the hood of a car and looking at all the elements of the engine and getting a much better idea of what's going on under the hood. And I think that's what we want to do when we go down a time frame. You're trying to find out what's really taking place in the rally. What kind of strength is behind it? We can certainly look at ADX in both cases. and see that the rally just didn't have the kind of strength. Look at there's no real green DI. ADX isn't even turning up with the stock's rallying up pretty significantly, but the ADX is going the other way. And that's taking place in both instances. So I'm not getting a lot of help as to say which one of these should I do. MACD isn't actually helping tremendously here because in most cases, both of them, they're basically crossing to the upside. And both are making a new high. There's not major divergence, although the histogram is showing divergence in both cases. But the price trend is a clear break on Microsoft, and it's not on Apple. So once this took place and I saw that, I probably would be focusing my time a little bit more on Microsoft. It's not to say that you couldn't do a trade in Apple. You could still use a break of the 18 here. You had a test of the high that failed. It really wasn't a 1, 2, 3. I mean, it was a tiny little rally bar and then turned down. I don't know if I would consider that a 1, 2, 3 change in trend. Whereas if I look at this, I see the break and a rally back up. I mean, that's a clear 1, 2, 3 change in trend, in my view. And if you were just looking at price bars on a closing basis, you got a really strong red bar right there. That could have been a trigger. I've said in prior videos, if you really want to improve your timing, I think you want to use the MACD crossover to really help you. And that's right where this crossed over was right before, a day or two before this is really getting ready to go down. Now, I want to make another point. Look at all the gaps that are taking place in these stocks, in both stocks, all over the place, gaps everywhere. This is not an ideal time frame or, type of environment, I should say, to be doing trades, swing trades. Swing trading is for more, consistent price behavior that doesn't have, it's not a lot, usually not a newsy type environment. Right now, we're dealing with the virus and all types of movement that can take place on a daily basis based on geopolitical, economic, stuff, and a lot of things where, what's going on with oil, just a lot of things that just are coming out of nowhere, very unpredictable, not the type of environment you really want to be a swing trader in. And one of the things I would look for is go and look at the average range of a stock. If it's skyrocketing, if it's really growing. So if I go back to a daily chart of Microsoft, you see how the size of these bars are not very big. That's a more ideal environment for swing trading. Notice what happens when the size of these bars starts to grow. Compared to these, they're about 3 to 4 times the size of these bars. So you always want to keep an eye out for that when you're determining what time frame you want to be trading. But I wanted to make this major point that if you watch the internal action, meaning if you go down a time frame and you look at the hourly chart, if you know the trend or the tradable time frame is the daily, go down to the next time frame, use that. You look for your 1, 2, 3 change in trend. That's also in my book, and look for your trigger using the MACD time frame to really help you with the timing of getting you in. So the point I wanted to make about all these gaps and everything is this is not an environment where I would put a trade on based on the stock. If I wanted to do this trade, I would do it in options. And the reason why I've said this in what I've been doing in the spider options is you can put on a trade and you can define the risk with the option. If I know my target area is down in this zone, say down in the let's call it mid 150s, and the stock is, in the say 165 to 170 zone, you could probably, even looking at the 150 options, those are out of the money compared to where your target is. But if we get a move down to the 155, something like that, these 150 options will explode. So you want to kind of look for, I think that's the best way to do it. Define your risk in dollars, have a money management plan that says, if I have a $50,000 account, I'm not going to risk more than 1%. Well, that would be $500. And so I'm going to go try and find options and maybe put 2 or 3 options on. It might cost you $1 or $2, $3, not sure. Try and keep the risk right around 1% of your account if you're going to do this type of trade. And, make sure everything's in place. Just because you're doing an option doesn't mean you can just put it on and forget about it. You're going to try and put the trade on at a perfect timing with MACD clicking in. And if the stock turns around and turns back up and breaks out above this peak up here, there's nothing wrong with selling the option, getting what you can for it. You don't have to take a full loss in the option. What it does is it minimizes your risk if you get a huge gap up to the upside. Let's say the Fed comes out and does something crazy. Not that seems to matter right now, but if the Fed came out and did something that caused the market to really take off overnight, you come in, the only thing you lose is what you put up in the option. You can't lose more. Whereas if you did the stock and it opens up at 180, you're going to lose that difference, and it's going to keep growing if you don't cover your short. So in these types of conditions, you got to be very, very careful about shorting stocks and holding them overnight. So much volatility. It's very, very difficult to make money consistently. Again, post any comments or questions you have. Hit the like button. We'll talk to you soon.